Good morning, good afternoon, good evening, everyone. It's an honor to be here with you today for day one of Financial Inclusion Week, an event the financial inclusion industry looks forward to every year. In case anyone tuning in is not familiar with CGAP, we are a global partnership that operates like a think and do tank. We are housed at the World Bank and we work to advance the lives of the poor, especially women, through financial inclusion. Let me start off today by saying there is much to applaud in what we as a sector have achieved so far. The release of the World Bank's Global Findex in June provided new evidence that the financial inclusion sector's efforts have been bearing fruit. The Global Findex is the preeminent worldwide measurement of financial inclusion. It found that the average rate of account ownership in developing economies had increased by 8 percentage points from 63% to 71% in the 4 years to 2021. More importantly, this increase in account ownership has been widespread across dozens of developing economies. This is remarkable progress. Findex data also show that there has been a significant increase in the use of accounts, as many initiated digital transactions during the pandemic. For example, the share of adults making or receiving digital payments in developing economies grew from 35% in 2014 to 57% in 2021. That's more than 20 percentage points. We also see that receiving a payment directly into an account is a gateway to using other financial services. Indeed, almost 2/3 of digital payment recipients also use their accounts to store money for cash management, about 40% use their accounts for savings, and 40% of payment recipients borrowed formally. Such developments are remarkable, and as importantly, they have provided us with a proof of concept that progress at scale is possible for financial inclusion. In addition, they are showing us that the pathways to get that progress at scales are clear. They include increasing connectivity, digitalizing financial services and payment, expanding agent networks, and providing adequate consumer protection frameworks to build trust. As a sector, our momentum is strong. In fact, if we project the same positive trend for financial access and digital payments that we have witnessed over the last 3 years, 90% of people living in low to medium income countries will have access to an account by 2030. I repeat, 90% by 2030. That's huge. And 86% will have made or received a digital payments within the preceding 12 months. Of course, such linear positive trends cannot be guaranteed. The COVID-19 pandemic, Russia's invasion of Ukraine, high inflation and food shortages have caused a humanitarian and economic catastrophe and have created an unprecedented degree of uncertainty. There are also countries where some of the key enablers that I've just mentioned are not yet in place, including countries where digital payments, for instance, are still in the minority, such as in Pakistan, Egypt, Cambodia, and Laos, among others. But if this positive scenario did come to pass, however, some would no doubt call it a major success. And as a community, we might be tempted to consider our job accomplished. And yet, 330 million individuals, likely the most vulnerable populations, would still be left without a bank account, let alone the broader range of financial services they might need. We therefore still have an important task to find ways to address the financial needs of these hard-to-serve segments that are at risk of remaining unbanked. And Findex gives us actually some hints regarding who these groups are likely to be, as it shows lower rates of inclusion among people in rural and agricultural areas, women, especially in countries with negative social norms, unemployed populations, and those living in fragile conditions. Findex also shows us that about 2/3 of those who are currently unbanked would find it difficult to manage an account without help, which further highlights that bridging the financial inclusion gap fully will require further work and research to develop the right solutions. So we certainly have a lot of work ahead of us. But more importantly, it is worth pausing here and asking ourselves as an industry, what do we think success looks like and how are we measuring it? Historically, progress in financial inclusion has often been measured by account access and usage, and that's what Findex has used as measurement. This translates into the number of people globally with access to an account and the percentage of those using their accounts. These measures focus mostly on the breadth of financial inclusion and for some time have served financial inclusion advocates, policymakers, and financial institutions very well by providing a clear and quantifiable targets to work towards. But we have always known that achieving universal account access and usage was not the end goal. Accessing and using accounts for transactions is not enough to bring poor people out of poverty. So the concept of depth of financial inclusion was added, because what helps people break the cycle of poverty is access to a set of financial tools, including savings, credit, remittances, and insurance too. Therefore, the idea was that financial inclusion should not remain shallow and limited to an account, but needed to go deep and embrace various financial instruments. However, while measuring such breadth and depth of financial inclusion have long been some of the defining success measures in the financial inclusion community, at CGAP we do not think this is enough. Breadth and depth are only meaningful if they also provide utility. That is, providing practical benefits and positive outcomes for the poor and their communities, such as by creating new income opportunities for individuals and strengthening society's resilience. The global Findex data illustrated that even though there has been a sharp increase, as I've just mentioned, in the number of people having access to an account, as well as in the number of people using these accounts, this has not yet led to a meaningful impact in terms, for instance, of resiliency or other development outcomes. For example, the data show that in developing economies, only 55% of adults could access emergency money in 30 days with little or no difficulty. And for the poorest 40% of households, only 40% say they would be able to cover the cost of an emergency. This really highlights the need for us as a sector to flip our mindsets. Instead of focusing on the mechanisms that create financial access and hoping that that will have a positive impact, we need to start with a focus on the impacts we want to generate and use that to shape and design the mechanisms. In other words, instead of focusing just on the provision of accounts or even other financial services, we need to shift our focus to the development outcomes that inclusive financial ecosystems can help achieve. Let me give you some examples. Instead, for instance, of simply focusing on setting up efficient G2P systems and infrastructure, if we shift our focus to ensuring the most vulnerable are able to adapt to climate change, then we can ensure that G2P systems are designed to be valuable social protection tools that can boost climate resilience. But that requires intentional changes in program design, such as in terms of eligibility criteria, links with early warning systems, trigger metrics, funding sources, and more. Hence, we need to start with those outcomes and design accordingly. A second example, in sub-Saharan Africa, adults report in the Findex survey that one of their biggest financial worries is paying school fees. So instead of focusing on the general provision of financial services, we might want to focus more specifically on enabling parents to pay school fees. And that might open up a range of different options, from digital wallets, pay-go systems, digital payment facilities that would enable friends and family members, for instance, to make direct payments to the school. A third, but slightly different example. Instead of trying to address women's financial exclusion one product at a time, if we start with the goal of ending the financial inclusion gender gap in a specific country, then we might take a more systemic approach. In fact, CGAP plans to identify one country to do just this. Working with partners, we will run a diagnostic, identify the many issues that limit women's financial inclusion, from social norms through to regulations and infrastructure issues, and then work with regulators, policymakers, financial services providers, and civil society to address each of these issues to create the impact we want to see, i.e. women equality, gender equality, and learn from it for the benefit of other countries. It's an ambitious project, and it's actually a risky project to focus on outcome because it puts the bar high for us as a community. It originated with a mindset that is focused primarily on the development outcomes inclusive financial ecosystems can create. We believe that this is the mindset needed to maximize a collective impact. We also believe that it is particularly important in our world today. The world has been shattered by varying shocks and overlapping vulnerabilities. Poverty and inequality are now on the rise. Already, millions of people have fallen into poverty since the outset of the COVID-19 pandemic. According to the World Bank, the pandemic has caused unprecedented reversals in poverty reduction, further exacerbated by rising inflation and the effects of the war in Ukraine. The World Bank estimates that these combined crises will lead to an additional 75 to 95 million people living in extreme poverty in 2022 compared to pre-pandemic projections. And just this year, we stood witness to profound climate disasters that shook many regions, from flooding in Pakistan to wildfires across Europe. These impacted billions of people around the world. Climate change alone could push another 132 million people into extreme poverty by 2030, again according to World Bank estimates. And the Intergovernmental Panel on Climate Change finds that women make up 80% of people forcibly displaced by climate-related disasters in developing economies. Women and girls also experience larger second and third-order effects, including increased risk of gender-based violence, dropping out of school, and early child marriage. But the challenges do not end there. According to World Bank's Global Economic Prospect report, we are going through the sharpest economic slump in 8 years. And this could trigger several years of above-average inflation and below-average growth, leading to a destabilizing period of stagflation. And it is again the poorest who will suffer the most. The World Bank reports, for instance, that the income losses of the poorest 40% were twice as high as those of the wealthiest 20% over the pandemic. In addition, record high debt levels are constraining countries' ability to respond to these challenges. The UN has identified 54 developing economies with severe debt problems, which are home to 50% of people living in extreme poverty. And some countries are actually spending more on debt interest payments than on health, education, and social protection combined, hindering the fight against poverty. In fact, food insecurity has re-emerged as a threat in 2022 that can exacerbate poverty and inequality. Humanity is fundamentally relearning that we cannot hide from the fragility of our world. One thing that we as a sector can and should do, given that context, is to bolster opportunities and resilience, particularly for the poor, who will be amongst the most affected by the impact of climate change and of the ongoing economic crisis, and have the least strategies and tools to anticipate and cope with these shocks and seize new income-generating opportunities. In this context, the provision of inclusive finance has become more important than ever. In the face of such challenging macroeconomic conditions, there has never been a more critical time for us to ensure that financial services are available to the poor and other excluded segments to help them prepare for, withstand, and recover from shocks and stresses. And as I've stressed several times already, those priorities are especially important for women who continue to be disproportionately excluded from socioeconomic opportunities and disproportionately exposed to shocks. And while financial inclusions, in terms of access and usage, is within our reach more than ever before, it is imperative that we push the boundaries further to ensure that financial services are designed to contribute intentionally and explicitly to addressing pressing global challenges, including for the poor and most vulnerable groups. As a sector, we need to redefine our objectives in terms of the outcomes we are trying to achieve, define new metrics to measure our success towards these outcomes, and then design every single one of our interventions with these outcomes in mind. In addition to redoubling our efforts to ensure that financial services not only become accessible to the million of people who remain unbanked or underserved, we now have the opportunity to build on our strong recent momentum to maximize the value, the utility that financial inclusion brings to the poor by ensuring that they help them address the extreme challenges they now face. If we don't act fast enough, we risk failing at our original mission to help the poor improve their well-being. It's probably unsurprising then that at CGAP, our new strategy will be focused on ensuring financial services contribute to sustainable development for the poor. We see sustainable development as comprising three components: green, resilient, and inclusive development, with inclusive finance as the key anchor for achieving these. Here are some of the highlights you can anticipate seeing in our new strategy. From a green perspective, we will be focusing on supporting mitigation, adaptation, and transitions for the poor through financial services. From a resilience perspective, we will be focusing on supporting greater resilience of the poor through financial services, and also on fostering inclusive finance in countries facing fragility, conflict, and violence. And from an inclusion perspective, we will be focusing on fostering women's empowerment, as well as productivity and growth of micro, small, and medium enterprises through digital financial inclusion. As mentioned earlier, we can expect public sector finances to be heavily constrained in the coming years. This further shifts our operating dynamic. There are some areas of financial inclusion that only the public sector will be able to address. For example, there are some customers who will only be servable from public solutions, and the public sector will also continue to be instrumental in providing the enabling environment for inclusive financial services. However, we must recognize the potential of the private sector to drive scale and impact. We have indeed already seen increased interest by investors to contribute to green, resilient, and inclusive outcomes. In 2021, there was approximately $1.6 trillion in flows of sustainable finance from the private sector. By comparison, total ODA was just $179 billion. While both the private and public sectors have been increasing their focus on sustainable and inclusive finance, the scale of funding flows is just dramatically different. Therefore, we will need to collectively build a clear and shared understanding of the respective roles of the public and the private sector in driving a broader agenda, and we will need to help design use cases for the private sector to contribute at scale. Last but not least, we will put a clear emphasis throughout our work on building responsible financial ecosystems and ensuring consumers' financial health, as consumers' risks are continuing to evolve and to grow and are exposing the poorest and most vulnerable the most. We will also pay attention to unintended consequences that could negatively impact our collective impact going forward. As we continue to develop and refine our strategy, we would very much value input, and we invite all of you to join us in defining the objectives we want to contribute to collectively, defining success measures aligned with these ambitions, and driving impact at scale. In order to deliver responsible finance for green, resilient, and inclusive development that hones in on the high-level outcomes we aspire to influence and the utility of financial services we wish to maximize, one thing is for certain: we will need to continue to work together as an industry. None of us can do it alone. For CGAP's part of the equation, we will continue to work closely with all stakeholders from the private and public sector and continue to partner with industry peers. Ultimately, we are all working towards the same goals, just playing different roles in the process. CGAP will continue to focus on influencing change through evidence, creating knowledge and insights for others to implement at scale in the market, and being at the frontier of financial inclusion, evaluating emerging dimensions that have the potential to shape our industry. We look forward to embarking on this journey together. Thank you.